Welcome to The Explainer. Today, we're taking a highly analytical, elite look at a silent threat that is probably sitting right inside your retirement portfolio as we speak. We're going to deep dive into how high net worth families can insulate their wealth from massive embedded tax liabilities, and really, how some highly specialized strategies can completely alter the final destination of your life's work. To do this, we're going to break down a comprehensive analysis from Harbor Light Wealth and Retirement Strategies. Now, if you aren't familiar, they're a premier family-run firm of licensed insurance agents located right on the South Shore, specializing in custom wealth protection and retirement analysis. And what makes their approach so uniquely powerful is how they actually build these multi-generational frameworks to protect your assets from the IRS, from market volatility, and, just from unpredictable life events in general. So here is the agenda for our masterclass today. We are mapping out a lifelong financial blueprint across 6 key areas: the retirement tax bomb, young families, peak earnings, protected income, legacy preservation, and finally, how to diffuse your tax liability. Let's jump right into Section 1, the retirement tax bomb. Most retirees completely miss this hidden threat because they're solely focused on just accumulating assets. But think about it like this. If you leave all your wealth in tax-deferred accounts, you're essentially exposing your lifelong savings to totally unknown future tax hikes and legislative uncertainty. Right now, top marginal tax rates are historically low, but the IRS essentially acts as a silent partner that could own up to 37%, maybe even more, of your traditional retirement accounts. If tax rates rise even a little bit, the effective cost of accessing your own money is going to increase significantly over a 20 or 30-year retirement. So, to counter this, Harbor Light engineers custom tax diversification strategies chronologically. Because, just like you diversify your investments across stocks and bonds, you absolutely have to diversify across tax treatments. This is how you ensure you don't lock all your wealth into taxable buckets as you progress through 4 very distinct life stages. Which brings us to Section 2, Young Families, Unbreakable Foundations. Let's look at how this builds for young folks in their 20s and 30s who are navigating early-stage debt and new mortgages. Take the hypothetical case of Ryan and Megan. They have a new baby, $500,000 mortgage. It's a lot. If Ryan, the primary earner, were to suddenly pass away, Megan would face immediate housing insecurity. So, Harbor Light structures cost-effective, high-limit term life insurance to guarantee that if tragedy strikes, the mortgage is cleared, debts are wiped out, and the family's financial trajectory remains entirely secure. It's an absolutely crucial foundational step before life gets far more complex. Moving right along to Section 3, Peak Earnings, Maximizing Accumulation. Now, as we transition into your 40s and 50s, the strategy naturally shifts. It becomes about maximizing wealth accumulation while insulating those assets from market corrections. These are your peak earning years, sure, but they're also your years of peak responsibility. For a high earner like Karen, let's say she's a forward-thinking executive, Harbor Light utilizes permanent life insurance structures. This gives her structural flexibility, tax-free accumulation, and dedicated capital for things like future long-term care needs. Karen was understandably worried about rising future tax brackets and healthcare vulnerabilities, but by using a maximum-funded, asset-based policy, she secures predictable, tax-free distribution options for retirement, plus a contractually backed bucket of capital if she ever needs home health assistance. It gives peak earners tax-free access to cash value while time is actually still on their side. Okay, let's intentionally hit pause right here. If you are sitting on a massive tax-deferred portfolio right now, wondering exactly how much of that balance actually belongs to you versus the IRS, you really need to evaluate your exposure. The team over at Harbor Light has put together an incredible, comprehensive 12-page guide called Diffusing the Retirement Tax Bomb that lays out the exact frameworks we're breaking down today. You need to visit www.harborlightretirement.com and click Get My Free Guide, or just call their South Shore office directly at 508-618-9991. Again, that's 508-618-9991. Seriously, don't wait until the IRS forces your hand. All right, back to our analysis. Section 4, Protected Income, Navigating Distributions. This is where we enter the danger zone, your 60s and 70s. Our focus here shifts to protecting your retirement income from forced taxation. And the crucial trigger point to remember is age 73. That's when the IRS mandates required minimum distributions, or RMDs. Suddenly, you are forced to make taxable withdrawals from your traditional IRAs and 401ks every single year, whether you actually need the money or not. And these forced withdrawals, they can easily push you into higher tax brackets and subject up to 85% of your hard-earned Social Security benefits to taxation. And it gets worse. Those forced RMDs can drastically inflate your income on paper, triggering massive Medicare IRMAA premium surcharges. IRMAA stands for Income-Related Monthly Adjustment Amount. If those forced withdrawals push your income over certain thresholds, it can literally cost you thousands of extra dollars in Medicare premiums every single year. It basically operates as a hidden tax on your own success. To see the profound impact of this, let's compare two hypothetical retirees, John and Susan. They have identical $1.2 million savings. John relied entirely on his traditional IRA. His RMDs grew, pushed him into higher tax brackets, triggered those IRMAA surcharges, and ended up costing him an estimated $400,000 to $500,000 in lifetime taxes. Now, Susan, on the other hand, utilized strategic Roth conversions and life insurance planning in her early 60s. This lowered her future RMDs, kept her Medicare premiums at the absolute base level, and saved her hundreds of thousands in lifetime taxes. Same exact starting point, but vastly different destinations. The mechanics Harbor Light uses here are incredibly precise. They safely reposition these assets through customized insurance structures to manufacture a guaranteed, contractually backed income floor that is completely independent of the stock market. By moving money from fully taxable buckets into tax-free life insurance structures, they give you absolute control over your distribution phase. They are effectively disarming the tax bomb before it has a chance to explode. Next up is Section 5, Legacy Preservation, Tax-Free Transfers. As you move into your 70s and beyond, the narrative shifts from generating income for yourself to securing an income tax-free wealth transfer for your heirs. A huge part of this is Harbor Light, protecting aging retirees from the Secure Act's 10-year rule. This piece of legislation now forces most non-spouse heirs to completely deplete inherited IRAs within 10 years, which heavily taxes them during their own peak earning years. By using properly structured life insurance, Harbor Light ensures your wealth passes smoothly, bypassing those complex probate delays, and goes directly to your beneficiaries entirely income tax-free, rather than becoming a massive accelerated tax burden. And finally, Section 6, Diffuse your tax liability. Ultimately, what we've seen today is that avoiding the retirement tax bomb isn't about luck. It's about highly specialized, forward-thinking planning. The difference between a peaceful retirement and a heavily taxed one comes down entirely to the structure you put in place today. To map out your own protected income floor, I highly encourage you to contact the family-run team at Harbor Light by calling 508-618-9991 or visiting harborlightretirement.com. You can schedule a complimentary retirement tax bomb analysis where they'll help you estimate your IRA tax liability, review your future RMDs, and analyze your legacy planning opportunities. We're going to leave you with this final, rather provocative thought to consider about the true destination of your lifelong hard work. It's time to protect more, keep more, and pass more on. Thank you so much for joining us for this explainer.